and I want to do options. Like, and I see, maybe I think it's going to get to this price and I just buy an option. I'm looking at all these things like the Greeks. I'm like, I don't really know what any of this stuff is. Like, I don't know what the Greeks are. I don't know like how I should be buying an option. Like what, like you kind of just gave people an explanation, but really just kind of break that down for people in a way they could comprehend,
Well, I mean, there's like you have the main Greeks, right? Delta, Gamma, Theta, and Vega, right? They each have their own sway to it, right? So the delta determines how much an option price will change for every dollar that changes in price. And then the gamma indicates how much delta will change when the underlying asset changes, right? So it's like, what the hell does that even mean?
Yeah,
like,
break them down.
What does that even mean, right?
Break them down how you see it.
So like if you're looking at the Greeks, right? Because if you're buying option contracts, the Greeks will be at the bottom of the contract, right? And they'll like explain everything. So the delta is pretty much the amount of money that your current option contract is going to go up per dollar. And the gamma is how much money is going to be added to the delta as the next dollar goes up, right? So delta and gamma kind of go hand in hand. Delta is how much is going to go up per dollar, and the gamma is how much is going to go up on the next dollar. So let's say if the delta is 60 cents and the gamma is 15 cents, on the first dollar that it goes up, you'll make 60 cents on that dollar, all right? On the next dollar, you'll make 75 cents because the delta and gamma add for the next buck. So probably have to watch that a few times to get it, but
yeah,
that's essentially what it is.
Even one of the first questions I had before you go on the rest of them, like when I first did options, which I'm sure some other people have too, is like when you see something is $7, but it's really not $7. Like sure. you see a $7 contract, but you're not actually paying $7 for it.
Oh yeah, because I mean you have to understand that the option contracts are 100 shares, right?
Yep.
So if you go in, right, and you see a contract like, oh, this contract is 60 cents, that means you're gonna pay $60 for it. The contract says, hey, it costs $2 to enter. That means you're gonna pay $200 for the contract entry.
Just little tidbits. I was like, I didn't know that.
Yeah, just little things, because I know you like to get all into the little intricacies because you want the beginners to follow up. So like I get that. I get that.
But yeah, go ahead the rest of the Greeks. I didn't mean to cut you off.
No, it's fine. So and then like you have the theta. The theta is something that, is on a long-term contract.
That theta be having a cricket. So
on the long-term contract, your theta is going to be extremely low. It's probably going to be a penny or two, right?
So what is the theta? What is the theta?
0.02. So the theta measures the daily drop in option price as it nears expiration, as long as everything else remains the same, right? So essentially, the theta is money that's going to be taken from you. That's money that the seller of the contract is going to collect. So that's money that you're going to lose every day as the buyer of the contract.
That's why the closer the time, the higher the theta is going to be. The farther out, we're good because
I'm
going to go out that much.
Like I like to talk to my buddies and tell them all the time, like, don't be a theta thought. Like you don't want to be there. That short-term contract is going to scorch you.
And that's why, guys,
it's so bad. Short-term contracts are so bad if you don't know what's going on.
These invest ethics that we have, like if you go on our Instagram, like you see in our, on our website, like these things were the culmination of years of trials of us getting smacked to really be like this earning season,
millions and millions of dollars in trades.
Even us. This is going to be our first time this earning season next week, like us actually putting these principles into play and following each one along the way. So like, I'm so excited to do this and to start a Discord.
Like people, people are going to make so much I really cash. Hope. Like this week is going to be really cool.
Yep.
We're going to show all you long-term leapers, which I think there's a lot. I would definitely look at some $10 calls on Riot for January 2026. Those are awesome.
Go on the rest of the groups.
Yeah.
We're gonna
drop that in there.
Yeah, that was crazy though. I already know. We're gonna really get on all that later on.
The Vega, right? The Vega helps investors understand how sensitive our option is to major price changes. So I mean, honestly, like the three that you really want to pay attention to is the delta, the gamma, and the theta. We could talk about the rho. The rho just measures the sensitivity of our option to interest rate changes. Interest rate changes are kind of nil right now. So, I mean, like, it'll be there, but it's not really active, Delta, gamma, theta, vega, and rho. But the delta in the game is really what you want to pay attention to, and the theta. Those short-term contracts have a lot of theta. So you will lose money hand over fist unless it moves in a direction that you need the stock to move in. And which, if you are betting short-term contracts, do yourself a favor and stay away from those out-of-the-money contracts unless you are absolutely certain that that stock is going to go where you need it to go.
And be comfortable losing what you're putting out. Like,
yeah, I mean, short-term contracts, you have a high probability of losing. Can you make money hand over fist, 500%, 600%? Yeah, we've been there.
There was somebody in Reddit, like when the past GameStop things were just going on, he was putting BlackBerry. He was putting like, remember that was like $7, $8 calls, and it was like $4. He put like 40 grand.
Yeah, yeah.
On like a one-way contract.
What was the first thing I told you?
Them shits are done.
The first thing I told you, when I saw him buying BlackBerry calls $2 out the money. What was BlackBerry trading at like $5? He was expecting
it was like $4.50, $4.60 or something. Man.
Like he was expecting BlackBerry to move up like 50% in a week. It's like, all right, like you can love meme stocks and you can dream, but don't throw your money in the garbage. Yeah. These guys are
don't buy the hype, guys. Like do your own research. Like do your own research.
Like, if you're gonna do short-term options, try to get a little in the money.
And I think
it'll save you a little bit.
And I think this breaks it down. Like I think we gave people a solid course, and of course we're gonna link Investopedia. I'm gonna get all the
Investopedia has everything for you.
We're gonna get all the sources for everything we talked about, so that you guys can do your own kind of research. But I think this is a great time to introduce what we're gonna be preaching, and the type of trades that we're gonna be doing is not just calls and puts, but we're going to be doing call debit spreads. And what would you say? Is it a put debit spread, or is it still called a call debit spread?
Right. So there's called debit spreads, which essentially other people refer to them as bull call spreads. So it's kind of interchangeable terms: call debit, bull call spreads. Essentially, when you buy a call and the money, and then you sell it out of the money call, and you collect the premium.
So what's the put side called? It's just the same thing.
It's called put credit.
Put credit, okay. Yeah. So explain.
So call debit, put credit.
So explain that, like, break that down. Like, if I'm going to buy a call, then I'm selling another one. So, like, what am I doing exactly?
I mean, for example,
what's the benefit and what's the cons?
I mean, the benefit of the call debit spread is that you get into a position at a discounted price, right? So, for example, let's say you're buying $20 calls on XYZ company, right? And let's say the $20 calls are going for $4, right? And you can get them for $4, right? And for every $4 that it goes up, you double up your money, right? So let's say.
Wait, break that down. So it's a $4 gap. So, like, explain it just so, like, because I'm like a little familiar, but I know somebody probably hearing that is like, what does that mean exactly?
Okay, so if you're purchasing a $20 call of XYZ company and the call price is $4, that means your break-even price is $24.
Okay.
So for every $4 that you go up because you invested $4, you'll make 100%. So if the stock goes from 24 to 28, you'll make 100%. Right? But you're buying the call contract for $4. Now, let's dial it back a little bit. Let's say the $20 call is $4. Now you have a $30 call that is $2, right? Those out of the money calls sometimes are still pricey during high volatility seasons, right? What you can essentially do is you can buy the $20 call for $4 and you can sell the $30 call for $2 and you can get a $10 spread. The $30 call minus the $20 call is a $10 spread. You can get in there for $2. Now, if the stock goes up to $28, instead of you just doubling up your money, since you bought the $20 and sold the $30, you'll make 300% on your money because you paid $2 to get in. So it's 22, 24, 26, 28. So that's a 300% return instead of getting 100% return.
Now, with the regular, if you would have just bought the $20 call now, you would have made more money, correct? If you would have just bought that, like you wouldn't have did the call debit. You wouldn't have did, like you would have probably made more.
No, Steve, you're confused. I just explained it. Like you're going to make less money.
No, I'm saying if you would have did it the other way, that's what I'm saying.
I mean,
that's all I'm saying.
Well, if you're just buying naked calls,
yeah, you would have made more. So that's like
no. If you buy naked calls, you're gonna make less money. Like you're gonna make less money when you buy naked calls. Like when you buy call debit spreads, you're gonna make more money.
Oh, all right.
Yeah, like if you buy naked, you're not gonna make as much money as you would with a call debit spread. Like you know that. Like call debit spreads, you'll make more money. More money, less risk, lower entry.
Fair enough,
Naked
yeah.
calls, more risk, higher premiums. So when people learn about call debit spreads, a lot of times there's a lot of people who trade options and they have no idea about call debit spreads. Like they don't know anything about the functionality of it or anything.
Yeah, I'm still kind of new too. That's why it's like I don't know as much either.
Yeah, like don't like confuse yourself.
Yeah.
Naked calls, you make less money. Call debit spreads, you make more money. Smaller entry, cheaper prices.
So there's no benefits of regular calls. There's zero benefits.
I'm not saying that. Everything varies. Everything varies. But you're going to make more money on call debit spreads unless there's a massive explosion in the stock. Which, let's say if the stock explodes to 32, right? From 20 to 32, you're going to make 200% on the naked call, but you're going to make 400% on the call debit spread. So you're always going to make more money on the call debit spread unless the stock goes up 50, 60%. Right?
Yeah.
Because call debit spreads caps your gains. But it's like...
Well, that's why I said that like that, because I just realized that it capped your gains.
Yeah. No,
so
like you sounded confused. That's why I'm like, oh, what's going on, guy?
Look like you about to slap me over the table.
Yeah. Almost for a little bit. But yeah, so it's just one of those things. You know what I mean? Like if you're going to focus, I would say learn call debit spreads. If you're buying naked calls right now, learn what call debit spreads are. They will change your life. That's how you really make money in these markets. Call debit spreads, aka bull call spreads. Learn that. If you can learn that online and you're already buying call options and trading call options and you're buying short terms, if you do that, it will change your life. Call debit spreads, aka bull call spreads. They're going to change your life immediately overnight.
Well, and how you made it sounds like very, simple, but there's a lot more that goes into it.
I mean, yeah. I mean, people are going to get a lot of cool things from the podcast, but call debit spreads will make you more money than naked calls unless you are anticipating a massive run. But even then, if you are, then I will go out of the money and do some call debit spreads. You will always make more money with call debit spreads, aka bull call spreads. Always. No questions asked. Hands down. Always going to make it. A lot of people don't know how to do it. Most people don't know how to do it. Most people don't know how to trade options. So, yeah.
A lot of the people we see, like I notice, like a lot of the people that I see, like on Instagram, you see ads. Like I'm not the only one. So many people see it, but you'll see them trading like futures, Mm-hmm. And it's like I think that's what people like only realize like that options is. Like you never see anybody online.
No, I mean, futures is something totally different.
But I'm saying
options.
I don't think people like get that.
Yeah, like we'll have a whole other episode on futures.
Yeah, if we
right?
want.
Like didn't we make like $8,500 on futures, or you don't remember that number either?
Yeah, I mean today, like Tony sits here and trades futures, and he has like there's a certain way you do it where you buy in, then you have to reach a threshold. I'm like, dog, what if you just bought in the account and you just fucking put the whole account up first day? And he's like, well, yeah, like I'd be trying to work towards it. I don't want to blow it all. I'm like, fuck that. Like last night, I'm like, dude, like here's my account. Put every single account up, like put all 15 up. Like I don't even care if I lose it. I'll just buy another.
Together. That's what it was all about.
Yeah.
It was a let's save together futures account.
Yeah, like 50-50. I told him like, bro, like I have the gusto and the money to do it, and you have the knowledge. Like let's run it. And I think the threshold was $9,000. What did it make? Like 8,500.
Yeah.
Today.
Yeah, like we literally slammed them.
Yeah, like crazy.
We let the 15 contracts fly last night when the Dow was up like 90 points, and we woke up the Dow was up like 225. So we just slammed out 9 Gs real quick.